Good morning, everybody, and welcome to the New York State Small Business Development Center's webinar series. I'm Kathy Fitzmaurice, the Customer Service and Training Manager with the Office of Entrepreneurial Education. I'm hosting today's program, Business Valuation Part 2. Your microphones and telephones are currently muted to eliminate background noise during the program. At the end of the presentation, we'll have a question and answer session. To ask a question, please type it into the question box on your control panel. I'll read the questions out loud. You can submit your questions at any time, however, they will not be answered until the end of the presentation. Today's program is being recorded and will be available through WebMQS in the Shared Resources section. We'll now get started. I'm pleased to introduce Peter Pappas, and Walter Reed is supposed to be with us today. And I don't see him yet, so we'll get, oh, there he is. So we're going to go ahead, though, and get started with Peter Pappas. Welcome, Peter.
Thank you. It's a pleasure to do this.
Peter, can't hear you.
Can you hear me now?
Yes, we can.
Okay. I'll start over. I was formerly with the Connecticut Small Business Development Center, and as I am pleased to say, it was the best job I ever had. I tell you that by way of letting you know that I'm one of you, or I can think like one of you because I've been there. And my presentation will be geared for an SBDC counselor. I do this every year at the National Convention, and Walter Reed kindly asked me to do this for you, and this is my first webinar, so here we go. There's several reasons why an SBDC counselor would want to do a valuation on a business. So our objectives today are to give you a simple technique that is within your comfort zone that you can do without violating one of our rules, that we do not want to become free substitutes for professionals like lawyers, accountants, engineers, or in this case, a valuation specialist. I want to give you a way to teach your clients why a business is worth what it is worth. A lot of people have a lot of misconceptions. In my stint at SBDC, I had clients come in and they'd say, my business is worth this, and I'd say, why? And he'd say, well, that's how much I've got into it, or that's how much I owe in it. It has nothing to do with the value of debts or assets or equity. And I'm going to give you some resources, and as Kathy said, this is going to be posted on for your use. You can go back anytime and find a professional valuation person. So there are many reasons why a client can come to you for a valuation or ask or bring up the subject. An owner may be curious, a business purchase or sale might be contemplated, and those are nice, easy things for you to deal with. And then we have more difficult things. There's a partnership change. They're taking in or eliminating a partner. What's their share worth? I want to pass this business on to my children. What is it worth, so we can get a rope around a strategy? And then there are things you're going to stay away from. State execution, legal action. You don't want to be an expert witness in court. You don't want to put yourself in a position to be asked to be. And as we go along, you'll see how you can stay on the safe side. A business is valued as any other investment, and it's simply the capitalization of a return. In stocks, we call it the price-earnings ratio. In bonds, we call it the debt ratio. And in commercial buildings, we call it the cap rate. And all these are subject to safety factors. A AA or AAA rated bond carries a lower interest rate and therefore a higher ratio than a junk bond, which would probably have 3 or 4 times the interest rate and 1/4 the ratio. So the formula is simply the value is the cap rate, the capitalization multiple, times the current return, plus a growth factor, and I'll get into that, how you probably don't have to worry about it, minus any debts that the buyer would assume, plus any cash or equivalent assets. It's irrelevant of the asset cost or value. I had a client come to me that he was taking on a partner in his gymnasium, and he said, "What is the business worth?" And I showed him how it recalculated, and it came up to $80,000. He said, "My equipment's worth $100,000. My answer was, "Then sell the equipment and be done with it, because your business is worth more dead than alive." If you want to talk about the value of the business, it's irrelevant of the cost or value of the assets. Now, capitalization rates for business are industry specific. The risk factor I talked about in stocks and bonds pretty much goes with the industry, and that's the key to what we're going to learn today on business valuation. Industry specific because industries have stabilities, ease of continuity, and this leads to our safe haven, the rules of thumb. Rules of thumb are based on assumptions. A successful succession, and I'll go into some of the things that make succession more or less likely to be successful. And each business category has its own rules. Right now I'm transferring a few medical practices, and the rule in that game is that the old physician, to maximize the value of the business, has to stay with the practice for 1 year. So he can introduce every single patient to the new doctor as they come in for their annual physical. Otherwise, patient retention is going to be very difficult. The buyers and sellers need to know them. Here's something you can do for them, is show them what in their industry they need to think about to maximize the value of their business. This is the book. This is the key to this whole presentation. This business reference guide, and there's a picture of it, has rules of thumb valuations for every type of business and major franchises. And I'll go into an example of how you use it in a little while. This is your safe haven. Using their rules of thumb, you can be safe in giving a client a valuation. You just calculate the return off their income statements, go to the page, look it up, show it to them, and you are not doing any valuation yourself. You're giving them a rule of thumb. The rule of thumb assumes a stable market, customer loyalty that's transferable, stable competition, no emerging alternatives, and compliance at town hall, no threats from town hall. This is something you as an SBDC counselor can educate your clients to, whether they're buying or selling a business. These are the things to look at to ensure the most value in a business transfer. I talked about growth factor. For a small business, you usually don't include a growth factor unless there's a track record. Many buyers get very optimistic and say, I can change this business, I can improve it, and that's dangerous. If that business has any kind of cash flow, and if it doesn't, it's worthless based on that formula, then the buyer needs to educate himself on what they're doing right, not what they're doing wrong, because something is working, and you as a counselor can direct them that way. Most of the time, any changes that a buyer makes are going to alienate the existing customer base. So an established but small business wouldn't have a growth factor in the valuation you're going to do, unless there are one of those two extenuating circumstances, which are based on track record. Caution your buyers, client buyers, that contraction is more likely in transition because client retention of 100% is unlikely. The growth factor is pure speculation, so SBDC counselors should stay away from it anyway. We've seen companies like Amazon that had a huge market valuation long before they had one dime of profit. You're not going to run into that situation, but that's the mindset you might run into in a buyer that you need to caution that they probably don't have on Amazon. And you're not going to get Jeff Bezos in your office anyway. They're going to go straight to venture capital. So what's your role? You educate the client. That's what we do best. We are educators, sometimes psychologists. Educate them the cost and asset value, usually irrelevant. How to figure out what their return is for that return on that is multiplied by the cap rate. How to pull that off their financial statements. You stick to the rule of thumb. Give them a copy of the page in the oral ballpark, and you're off the hook as going beyond the scope of your services. And you refer them to experts. Now, in referring to experts, caution your sellers that if they have a buyer, that from then on, they should, by rights, pay all legal fees, accounting fees, and everything personally, not through the business, because they're going to deplete the product that they've agreed to sell. It would be like buying a bushel of corn, and the farmer takes 10 ears out for his family dinner before he delivers it. Now, there are ways a seller can increase value, and you can help show them the way. Refocus the strategy. Give them a business plan. That's something we do really well. See if they have the potential of expanding to new markets, especially if they can get new reoccurring accounts. A lot of people who've been in business for a while get a little lazy, and they could chase down some more business, but they say, why do I need to? I'm paying off all my bills, I'm living well, and I want 4 vacations a year. They can go after collections. They can improve collections in one of 2 ways. Now, just accelerating collections is a wash on the value of the business because they're trading one cash equivalent, good accounts receivable, for another cash. They shouldn't undertake any new capital expenses unless they have tired equipment that is detracting from the value, and they shouldn't take on any long-term contracts like waste hauling or advertising because that encumbers the buyer, and that can come out in due diligence, which is the period of time between the offer and the closing where the buyer gets to look at the details. Settle lawsuits, claims, and disputes. These contingent liabilities can really affect the offers that a buyer would be willing to make. And get rid of deadwood. If there's a cousin that works there that isn't worth his salary, now's the time to tell him to find another job and write off bad debts, which is the other side of the coin from improving collections. The bad debts are going to come out at due diligence, so get them off the books now. Now, there are deceptive tricks. If you have a buyer client, you can watch for these and teach them that these are possible. A seller might deliberately cut necessary expenses to the bone to make the bottom line look good so he gets a higher multiple. Cutting staff, reducing employee benefits, these are all short-term gains that have long-term adverse consequences. They can take on customers that are not good payers. They can sell down inventory. I've had one case where a client was selling a pet store, and she was going along at break even, and the year before she put it up for sale, she had a $25,000 profit. I drilled down into that. What she did was she maxed out her credit cards, put $25,000 into the business, and booked it as sales instead of owner investment. And they can cut the owner's non-salary competition, the perks that an owner gets out of the business that aren't booked as salary but nevertheless are expensed. The moral is, look back. If you have a pattern for a few years before the year of the sale and something changes, there's got to be a reason. And there are industry standards. This would be a good time to tell your clients to invest in a Hoover's report on that industry to see if the seller is within the tolerable range of the industry. Now, that book I showed you also has some rules of thumb on major things like cost of goods sold, rent, payroll, so you have something to go on there. Now, considering assets, remember the value of the assets has nothing to do with the value of the business, but you want to caution buyers that to look at the equipment, see if it's serviceable. They don't have to get behind the counter. They can stake out the place and see how the operation works. Is it within the current range of state-of-the-art, or is it obsolete and inefficient? Is it production balanced? If a print shop has 5 presses and 1 folding machine, they probably got 2 presses idle most of the time. Is the inventory merchantable? Damaged or obsolete? Is it appropriate for the business? A pet shop that has food products for people probably has a lot of inventory that isn't of value to that particular business. And these issues will probably come up during due diligence, that period between the offer and the closing where the buyer gets full access to the business. And I always caution clients who are buyers to make their offer letter conditional on things like serviceable equipment, merchantable inventory, no judgments or liens outstanding, no payables above a certain amount, no receivables of at least a certain amount, so that the buyer's offer can change after due diligence without violating the terms of the offer. So we want to get the right financial data. A lot of people think tax returns are a reliable indicator of the business. That's not necessarily true. It is true that people are less likely to rely on a tax return than in an internal report. But remember that tax returns are solely prepared to minimize the tax, and they use the accrual effect as much as possible to do this. Accruals have nothing to do with the true bottom line. They're non-cash expenses. Get access to the accounting system. I love it when I can get a copy of the QuickBooks, take it home, and drill down and see what's going on and look back several years. And we want to find out what the accountant is doing as far as an audit before we prepare that return. Somewhere in the process, I'd want to get my buyer to have permission or me to have permission to talk to the accountant. In the early stages when that's not possible, I'd ask to see the audit letter. Every accountant issues a letter every year saying, this is what I did for the audit. I took the client, most of them say, I took the client's books and I reduced them to a tax return. I did not check inventory. I did not check claimed receivables or payables. Now, there's several ways to measure the return. The R that is going to be multiplied by the cap rate, the C, to get the value of the business. There's profit. There's earnings before interest and taxes, earnings before interest, taxes, depreciation, and amortization. I used to call that cash flow, but nowadays that identifies me with somebody that had a lot of experience with the dial phone. Seller's disposable income. This is my favorite. It's always the highest of the 3, but it's very accurate for a closely held business because it indicates what the seller is getting from the business, what the buyer will be getting from the business. That, to me, is the stream of income that we capitalize. Now, the SDE is the owner's salary and all other benefits. Passive income. A lot of owners pay themselves rent because that's not subject to Social Security. And it's not subject to workers' comp if they have a workers' comp policy that covers themselves. A lot of owners get the use of assets. A garage mechanic that uses the bay and all the tools in the garage to fix his cars and his friends' cars for a little cash, that's something that's worth something to the value of the business. And a lot of it, entertainment, meals out, totem privileges. The restaurant owner that takes food home for his family, that's totem privileges. Many times the seller will overstate this because they know it adds to the value, especially if they figured out what I've told you so far. But you do not add back opportunity and waste. The SDE is the total company cost of the owner's complete compensation package. It's company cost, not market value. The value of the groceries that person takes home from his restaurant is the cost of the company, not its retail value at the local supermarket. Determining SDE involves add-backs. They must be completely unnecessary for the business. They can be part of a line item that is other part necessary, like the food cost in the restaurant where the owner takes the groceries home. Be dollar quantifiable, not speculative. It's a profit trade-off. And we all know that they should be paying taxes on these perks, but tax treatment is another story. Remember I said tax returns aren't always the best indicator of the value of a business. If they're getting away with something, you might add back the after-tax effect of that. And it can't be part of a completely different business. If they're getting a benefit that is not part of their business, that doesn't count. Benefits like that might be discounts from their own suppliers. They do a lot of business with somebody, and they take care of them personally. Auto expense. Do you add that back? Is that an owner's perk? Well, if the owner has one restaurant and uses it to commute, that is not necessary for the business. So we'd add back the cost of that, the cost of operating that company car, not mileage like the IRS figures that, not the value of the used car. On the other hand, if the vehicle is necessary for the business, you can't add it back. Unless, let's say in this contractor, he's driving a Hummer, well, when a Chevy Tahoe would do. Well, there is some add back possible, but it's tough to figure. The expense has to be completely unnecessary for the business. And the SDE add backs can come from anywhere. Anything in the whole chart of accounts might contain an owner perk. But remember, if eliminating these business expenses strips the business of something it needs, the add back is excessive. So I'm going to do an example using EBITDA because it's easy to calculate. I don't have to figure out where the owner's perks are in this income statement. We add back interest, depreciation, and taxes to the net profit, and we get an EBITDA of $220,000 plus. Then we go to the book, and here's what a page of the book looks like. Full-service restaurants, we go down to EBITDA, 2 to 3 times EBITDA, so I'd split the difference and use 1.5. Now, interestingly, SDE plus inventory is a cash equivalent in a restaurant if it's merchantable. And there's an inventory problem I'll go through in a little while. So this business is worth $550,000 plus based on the rule of thumb. Now you've given the client a value and not overstepped the scope of your services. Every industry, every franchise has a different rule of thumb. In this business, depreciation is significant because the difference between EBITDA and EBIT, where the difference is depreciation, is significant, 7 times to a nominal 1.5 times. The assets are marketable when you see assets plus, very rarely, so they must be a cash equivalent standard production equipment. Here's a franchise. One rule of thumb, 40% of annual sales plus inventory. Why? Because these are cookie-cutter operations, and sales is closely related to net, closely related to SDE, EBITDA, whatever way you calculate it. You don't need to go much further in most franchises. Inventory is a cash equivalent, but it varies greatly depending on the timing of close. In a restaurant of this magnitude, about $7,000 average value, probably twice that the day after delivery, half that the day before delivery. And inventory, the accounting system is not going to help you with inventory because it only increases when the payables are booked, when the bill comes in. Delivery tickets are seldom booked, so there can be quite a time lag between booking statements after inventory is on the shelf. So we want to contact major vendors and find out what their payables procedures are to see if the invoices are on the books properly, and there's going to be no substitute for physical inventory on the day of the closing. Real estate complications. People will come to me for evaluation. I'll tell them what I think, and they'll say, but the real estate's worth more than that. I say, move the business or close it and sell the real estate. Remember, the return on income approach. If the business is not the highest and best use, if the real estate's worth more, the business is worth more dead than alive. Move it or close it. A planned future sale can contribute to ROI. Let's say the business is in a valuable piece of real estate. We do a business plan that says we're going to move the business and then sell the real estate. Well, we have a different stream of income to capitalize. Carving out the real estate, very commonly done. The seller will sell the business and the real estate separately, sell the business only and rent to own. The rent is a wash. The rent takes away value from the business, therefore makes it worth less valuable. So by taking his business and making it pay rent, the return is less, the value is less. Although this can assist a sale by doing a type of owner financing that's fairly safe. The owner retains the real estate with an option to buy it later. Alternatives to the income approach. Well, there are several comparable sales. You see this in home valuations all the time. Very good for residential real estate. Not appropriate for business except perhaps rental property because you need comps. And businesses are unique. But this is a good way to benchmark it. Any data has to be considered. Each business has a unique quality, and that is mostly goodwill, market strength. Could be intellectual property or could be a very positive culture. And comparable sales are always subject to state of the market. We've seen a lot of comp changes in real estate, residential real estate. And then there's some alternatives. The assessor's valuation, well, it's a published piece of data. It has to be considered, but it's calculated by the cost less the statutory depreciation. It has nothing to do with market value. Book value really is irrelevant to the value of the business, but I have seen it work in estate cases where an owner transfers a fractional interest to his children and uses book value as the valuation. But I'm talking about fractions of 1 or 2%. Replacement value, well, possibly on rental property. It's a high limit, and it also generates a make or buy decision, because any buyer should also consider what it would take to open a competing business as opposed to buying an existing business. You're not going to get involved with this, but you will need to educate your clients as to discounts or premiums over the business valuation based on return of income. Discounts for lack of control. A minority interest in a closely held business is worth a lot less than its share than a controlling interest. Marketability. If there are restrictions on transfers for a partner, that would reduce the value of that partner's interest in the business. illiquidity is the other side of that coin. If you can't sell it, it's not very valuable. Trapped-in capital gains, you'll very rarely see that. That's usually common in divorce cases where the wife gets the use of the house till the children are grown, and then sells it and splits the profit. Well, the value of the capital gain is trapped in, and eventually tax has to be paid. But if the buyer is contemplating selling a major asset or a sale and leaseback of a highly depreciated asset, there could be a recapture on that. So you can make your clients aware that this might be a pitfall. A key person discount. If one person is the rainmaker, and the rainmaker isn't under contract, that may impact the value of the business. And the other side of the coin is premiums for control and competitive advantage. And you see that in the stock market. Somebody will buy 10–15% of the company and then make a tender offer for the controlling interest and pay 20% over the market value. And now, finally, professional appraisers. An accountant-accredited business valuation, they are out there. Usually this will take a referral because most CPAs don't go that extra distance. You can get a referral from the client's accountant, but if he is qualified, I wouldn't let him do it because there's a built-in conflict of interest. I'd be surprised if he'd be willing. I'd be suspicious. And then there's organizations you can contact and get a local valuation analyst. And that concludes my show. Walter, do you have something to say?
Thank you very much, Peter.
Okay,
I'm not Walter, it's still Kathy. But we're going to go over to Walter now. So in just a minute, we will hear Walter speaking, if all goes well. And Walter has completely disappeared. I apologize, everybody. Well, let's maybe Walter will come back, but in the meantime, we do have one question so far that's been asked. Brooke James asks, for a buyer, internal financials are important, but for a lender, don't the tax returns need to show profit? What should be advised here for the seller?
I think most lenders are aware of the uniqueness of tax returns. I mean, a tax return showing a loss is probably not good, but I've done a lot of loan packages with tax returns that are at or just above break even, but with projections that are supported with historical internal data, and it's worked. So yeah, a losing tax return is going to negatively impact any lender or investor, but a break-even or near break-even is not so difficult. Any other questions?
It looks like, audience, if you have any other questions, please do type them into your control panel. And I think we have Walter ready to go. So go ahead, Walter.
Okay, thank you, Kathy. Thank you, Peter. First of all, I just want to thank Peter for appearing today and making today's presentation on business valuation. If you recall, everybody who might be here, Alexis Mockler of the Research Network did part 1 of the business evaluation. And what she did, she gave a pretty good seminar and lecture on the rules of thumb and evaluating a small business. And I just want to thank Peter for doing what he did today. He put on an excellent presentation. I met Peter about 2 weeks ago at the SBDC convention in Orlando. And it's funny, at that point, Alexis asked me to participate in this seminar. And I said I'd love to, because in my deep sordid past, I was a partner in a business brokerage operation, and I was involved in buying businesses on my own. And I always loved the topic. It intrigued me. And lately, I've noticed in my activities with the SBDC, as I think you all have too, there's been sort of a reemergence or an increasing situation where people are buying businesses again. Since the start of the not-so-great recession, business was a lot of businesses were just trying to hold on their own. Evaluations were gone down because of lack of sales and corresponding evaluations going down. So there wasn't too much buying and selling of businesses going on in the last couple of years. But if I'm typical of the or representative of the typical SBDC advisor, I think that this topic is starting to pick up a little bit. And just in the past 6 months, I've had 3 business acquisitions go through, 2 of which involve property. So it was a very fortuitous time to meet Peter about 2 weeks ago. Peter's a very modest guy. What I had intended to do, I was going to open up the seminar, but because I'll call it technical difficulties, okay, but really it was operator error probably. Okay, but in any event, I'm up online right now, but I just do want to just describe a little bit about Peter's background. Peter was really nice enough to be here today. He's right across the state line in Connecticut. But Peter is an established expert in small business management, as we all know. In the past, he was an adjunct professor of business and director of the Mitchell College Center for Entrepreneurship. Prior to that, he was the regional director of the Connecticut Small Business Development Center. So as he said before, he's a member of the family, and he offered to continue to be a member of the family until somebody hits him with divorce papers. Trained as an engineer, he has designed and built manufacturing plants and retail centers in the U.S. and Mexico. As an entrepreneur, he has been the chief executive officer of several closely held retail and service businesses. He currently is in private practice, consulting on business purchases, sales, finance, and strategy. He's managed mergers and acquisitions of publicly and privately held businesses and transactions from the $25,000 to the $50 million level. He holds a BS in Industrial Management from Lowell Technology Institute and an MBA from Northeastern University. And he's the founder and owner of Solutions for Business and Nonprofits. Okay? So I think that could give you a pretty good idea of what Peter is all about. As far as my background goes, again, for those of you fortunate enough not to know me, my name is Walter Reed. I've been with the SBDC for about 15 years now. But before that, I had a lifetime as a toy retail buyer. And when the company that I was working for was about to be sold, I was involuntarily retired. Okay? And at that point, what I decided to do was to look for a business on my own. And having experience in the toy retail business, me and my partner at the company that my boss actually, at the company that I worked with, decided to buy our own toy company. So I got involved in about 3 negotiations to buy existing toy companies, none of which probably, fortunately for me and my partner, worked out. But what that did, that little activity there that spurred my interest in business acquisitions, I had an opportunity to be a partner in a business brokerage business. That was when I lived on Staten Island. And if anybody is driving through Staten Island or listening on Staten Island today, you'll see a sign on Forest Avenue that says New York Business Brokerage, right on Salmon Realty. Well, the sign is there, but I'm not there. I'm here right now. But it was an ill-fated business brokerage, and I left that after about 6 months and eventually came to the SBDC. So that's my background. Briefly, what I want to talk to today, and as you could see from Peter's explanation, the devil is always in the details when it comes to evaluating a business. And evaluating a business, especially in a small neighborhood service business like we have most familiarity with, it's a matter of negotiation. Most businesses don't have detailed audited financial statements. It's almost an impossibility. The owners don't want to invest into the expense to do it, and the nature of the assets and the inventory really doesn't warrant it. So in that case, what the buyer has to do is determine it on his own, what he's going to value and what he's going to buy. But there are basically 3 steps to evaluating a business. The first one is basically updating all the financial statements. Now, Peter did a really good job on explaining what the pros and the cons of financial statements are. But basically, as we're all familiar as SBA advisors, whenever we do deal with acquisitions or even SBA loans for that matter, there's a couple of financial statements that are absolutely critical that we need to give us the material that we need to make an evaluation on. One of which, of course, would be the income statement, okay, showing the gross revenue, costs, and how much your business made every year. Another statement, which is probably even more important, is the cash flow statement, because that basically shows how money was received and paid out of your business. And more important than that, it shows how business assets changed as a result. And again, too, the last but not least financial statement that you would require before you start to establish a valuation amount would be the balance sheet. And the balance sheet should show you the value of all tangible and intangible assets owned by the business, less the liabilities, of course. So basically, those are that's one step. That's the first step that you've got to consider. The next step is, well, now that you have an asset list or you have a balance sheet, what you've got to do is to consider the value of the assets. Very simple. You know, the assets are tangible and intangible items. The tangible items are pretty self-explanatory. They're furniture, they're fixtures, and their equipment and their inventory. There are several ways, as Peter said, to determine that, depending on the size of the business. But in a lot of small, closely held businesses, as I was a business broker, okay, let me get the slide up a little bit. We had a very scientific principle that we used to use, okay? Because as I said, a large part of what you do when you do buy a business is determining what the assets are, and there's an awful lot of negotiation involved in that. And I have a slide up right here. I think it's available, but it's called Making a Swag, okay? And, okay, let me just, I have to minimize something. Okay. Okay, generally if you're dealing with a small business that has a lot of assets that might not appear on the balance sheet, you have to come up with another way of determining valuation of those assets, okay? And once you generally understand the acceptable methods of business valuation, you have to go sometimes a little bit out of the box. And to do that, sometimes what you have to do, you have to apply a scientific wild asset guess, because as a practical matter, detailed implementation of that generally accepted methods may be too expensive or too time-consuming for the purpose of hand. In the majority of cases, net book value is a lower limit of reasonable value for equipment on an ongoing basis, because most privately held companies write off depreciation at least as fact as a useful life. For some types of equipment, a reasonable approximation of current value would simply be the undepreciated original cost. And this is important because the reasoning involved in this is that inflation in the cost of new equipment has proceeded at a pace at least fast enough to offset any physical deterioration and obsolescence in well-maintained used equipment. That was generally true for several years, especially in the years of high inflation, which we really don't have right now, so that aspect of it might somewhat be de-emphasized. But there are a couple of industries where that was particularly true, and mentioned as airplanes, trucks, rolling stock, and other inventories where assets have a very long useful life, and in fact where the useful life exceeds the life of the depreciation. Very often you would look at assets on the tax statement, and they would be fully depreciated, you know, which means there's no depreciation left. Now that doesn't mean that the assets are worth nothing, because some assets are serviceable well beyond 10, 15, or 20 years. You know, that might be any type of equipment. It might be some sort of leasehold improvements or anything at all like that. So there, even though there's no depreciable value left on that, there is a market value to that. And that's where the swag analysis comes in. So that's one thing that in a small service neighborhood business, which is very typical of our clients, by the way. You know, we don't get, there's a reason why they call this small business valuation, because there are you know, differences between evaluating a small business and a much larger business. Okay, and then again too, what you have to do, basically, what a seller thinks a business is worth is probably twice what it really is, and what a buyer thinks that the business is worth is probably half of what it's worth. And a lot of the disagreement on that is on the intangibles. Those are assets that where the value could be negotiable. And I have a slide on this, I hope. Let me see if I could get it up. Yeah, just briefly. I'm not going to, I hope this screen is on your monitor. I hope it is. I'm not going to go on to each and every one of these, but these listings right over here could be considered intangible assets. Those are things that have value to the company, but maybe not appear on a balance sheet or are a little bit difficult to consider. But this is a very important item too. Recently I had a client come up to me, a young girl. She wanted to buy a spa, and it was not a very expensively priced business. It was basically, I think the owner was looking for about $75,000 on it. So I asked my client, of course, to come up with a seller's agreement and a balance sheet. And on the balance sheet, she had a $25,000 asset value for a restrictive covenant. And I asked her what that restrictive covenant was, because someone buying a spa, I just had no conception of what that might be. And my client, who was ready to make an offer based on the representation of what the owner said the assets would be, was just ready to accept that, stating that, okay, fine, if I want this business, I got to buy this restrictive covenant, not knowing what it was. So I told my client to call the seller and find out exactly what this restrictive covenant was. And she told me, she said, oh, when the current owner bought the business 2 or 3 years prior, she signed a do not compete clause with the person that she bought it from. And what she did, she paid $25,000 for a do not compete clause, meaning that the seller of the business at that time would agree not to open up a similar business for maybe a 10 or 15-mile radius. And so the owner was willing to pay $25,000 for that do not compete clause. Well, my advice to the client was that, gee, that was a very stupid mistake. Just because a seller might not be intent on opening up a spa within a 10 or 15-mile radius, there's no reason why anybody else is not going to do it. And in fact, they most probably will. The one thing about business is you could always depend on competition and new competitors coming on the market. And I felt that it was unlikely for this client, who only had the business for about 2.5 years prior to putting it on sale. The reason why she was getting out of the business was because, number one, it wasn't making that much money. Number two, it was taking up too much of her time. I said the likelihood of this individual ever going into the same business and starting all over again is very negligible. So I advised my client, I said, hey, listen, that might be down on the books as a $25,000 asset, but it's not worth anything, and I would not buy it if I were you. Okay? And I always advise my clients, too, to say that it's up to the client to propose an offer, and it's up to the client to determine the value of the assets, and in fact, even more than that, what assets you want to buy and what assets you do not want to buy. From my own experience, before I went into the business brokerage business, I was negotiating to buy a toy store on Staten Island called Smiling Sunnies. Okay, it was a great store. It had been there forever. I think this is going back about 20 years. I think the sales were about $2 million. And when I started to do my diligence on the business, I found out that even though their annual sales were in the roughly $2 million range, they had a very favorable lease and the cost of operations was very low. And as far as comparable analysis of different retail toy businesses, there was a pretty good profit potential versus some of the other ones that I looked at. But when I got involved, I looked into the store, and I was in the toy business for about 15 years before that. So when I see a 2,500 or a 3,000 square foot store, I know what the asset value of the inventory is at that point. And the owner disclosed, he said, well, I've got $1.5 million in inventory. And I said, gee, I don't see it over here. Where is it? And so the owner told me that, I have 2 garages at my home in Westchester. Okay, they're filled with not cars, but they're filled with toys. I've got my mother, who also lives in Westchester, has another garage filled with toys. So I didn't even bother looking at it because I knew that from a retail angle, you do not want to buy inventory which is more than about 60 days of what you're intending to sell. There's such a thing as an inventory turn. And so what I'm saying is that this owner had about 2 years of inventory, okay, at current sales levels that he had. Well, that was completely unacceptable to me. Number one, I wasn't going to buy any. If his sales were about $2 million, I wasn't prepared to spend more than about $400,000 for inventory based on that ratio. And also, to accumulate that much inventory, a lot of it has got to be stale and outdated. So this is where I said negotiation is such an important technique when you're discussing assets and trying to determine an asset value. Basically, I told the owner that he said that the toys were antiques, valuable antiques, and in my judgment, they were junk, because if they haven't sold in 10 years, they're not about to sell. So that sort of killed the sale right there. So that's some of the personal experience that I do have other experiences when it comes to determining assets too. I have a lot of personal experiences that I could tell too. I had, let's see, one time I had somebody who owned a bar, an Irish bar, come to me, and he wanted to sell his business. He had his business in Brooklyn. And I said, well, have you decided how much you want to sell it for? And he said, yes, we do about $12,000 during the week of St. Patrick's Day. And usually these bars sell for 20 times that sales volume. And I was amazed. I said, that can't be. Evaluation is a determination of income and assets, and that's how it's done. But lo and behold, about 6 months later, I had another person come to me. He had an Irish bar, and he wanted to sell it, and he told me that his selling price was about 12 times what the weekly sales were during the week of St. Patrick's Day. Well, I found out later that this is sort of a customary way of evaluation certain types of bar businesses in New York. They have to be a small neighborhood bar where the bar has a seating of about 14 to 15 people, and there's 3 or 4 seats. So if those neighborhood bars fall into that parameter, then that was an acceptable way of determining the value of the business. Okay. So the next step would be to prepare. Step number 3, I went on a little bit more than I should have on the assets, would be to prepare the seller's discretionary earnings. Okay. Now Peter went on describing that for quite a while, but the seller's discretionary earnings are basically what the seller takes out of a business as far as salary and profit goes. Okay. Peter did a pretty good, a very good detailed explanation of that too, as far as what the add backs and the subtractions would be. I was going to talk about that, but time is running a little bit late, so I won't do that. And basically, I did have one example that I wanted to show too. There are a couple of acceptable ways of measuring, of determining a multiple for evaluating a business. And for the past couple of years, there was a company out there called Newground Publications, and they came up with a very good tutorial on buying and selling a business and business evaluations for the type of businesses that the SBDC generally works with. Let me tell everybody, I have a PDF on this. I would be more than happy to share it with people. In fact, I think what I will do is I'll send a copy of this to Darren, because I think it's something that he might consider for the shared resource sections in the research network, okay? But very briefly, since time is going out, I like this way to calculate a business multiple, because what it does, it sort of customizes the business. It gives us a little bit more of an individual effect on the business rather than a national industry trend. And as you can see, there's 13 factors that go into calculating the SDE on this particular thing, from risk to competition all the way down to technology. And if you look at this, what you would do, you would assign a numerical number from 1 to 6, okay, with 6 being, the higher number would be for the less risk, and the lower number would be for more risk, for instance, in that situation over there. So what that does, that includes some considerations which are important, which is the age of the business, because that gives you an idea of how stable the business and how it's going to continue. It gives you an idea of if the customers are steady, and you could assign a valuation to that. If technology affects the business, is it technology dependent or not technology dependent, and put an evaluation on that. The owner's reason for selling, which is very important. If he's honest and says, I'm just not making enough money on this, it would be a very low rating. You would look at the growth over time over the business. If its sales are going at a very good clip, you would assign that a higher rating. So very simply, you would just put an evaluation for all of these factors down here on these 13 factors, get a total, and then divide by 13, and that would be the multiple that you would use. And I've been using that for about 15 years now, and I have no reason not to. So at this point, what I was going to do is to turn over the presentation to Peter Pappas. Since he gave his presentation, there's no longer anything to, there's no longer any reason to turn it over to him. But in that case, I just want to thank everybody for tuning in here today. I hope everybody got a really good understanding of what business evaluation is all about, what an SBDC advisor should and shouldn't do. And please call me. I'm available at the Farmingdale SBDC. And do contact Peter, whose contact information is on this PowerPoint. So at this point, if there are any other questions, I'd be willing to entertain them.
Thank you, Walter. I do have everybody muted, but they've been typing in questions. I've got one from Beth Reed for Peter. Peter, would you expand on what internal documentation would best support a lender and buyer paying a premium for low-profit tax returns?
I'd say internal financial statements that have been audited can support projections. The lenders are more interested in what's going to happen than what did happen, and if we can show trends, if we can show increasing market share, that would be very helpful. I don't do projections with guesstimates. I hate that word. It's the devil's spawn. Everything has to come from reality, and when you're doing projections, the cost side is easy. Everything has a cost that can be known to the penny. It's the sales side of the projections that has the devil in the details, and that has to come from reality. If there's a track record and a trend, we can use that. We can use industry figures, same-store sales, like in similar businesses, but never guesstimates. Lenders are looking, in addition to financial projections that show the loan can be repaid, they're looking to the character and the collateral, of course. But let's face it, folks, of all the deals I've seen, only 5% are bankable. Another 1% are bankable with enhancement, which means a guarantor, most commonly our friends at the SBA. And then there's a small fraction that qualify for special lenders who are economic development funds that are looking to light up gray buildings and provide jobs and taxes, and they don't generally can only take deals that aren't bankable. So a lot of times when I'm doing a loan package, I get to a certain point and I say, I can't take this to a bank. We're going to have to do equity here. This is the only way is your money, your partner's money, and friends, family, and fools. Are there any other questions?
We have another one from Nick Ferrara. Are there rules of thumb in evaluating goodwill?
Goodwill is usually built into the current return. That's why it's so easy to do when you have a track record. Somebody once asked me, what about a business that doesn't have any profit? On the return on equity model, it's not worth anything. But unless something has changed to increase goodwill, such as the granting of a patent, a new customer contract coming on, and we have to do some forward-looking projections to get an income that we can do a return on equity, a return on income calculation for. Anything else?
Are there any other questions? We're just about out of time. If you do have more questions, feel free to forward them to me or to Walter, and we'll get them answered for you. Thank you again, Walter and Peter. This was a great presentation. Thank you, everybody else, for attending, and have a great day.
Thank you.